Hello and welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. Also hit the notification bell so that whenever you upload a new video, you are notified. In this video, we'll be talking about Tanzania's post-election violence, and we'll be asking a question: will it blow apart the mega projects such as SGR, LNG, ECOP, and other mega projects? Here we ask a simple but urgent questions. After the disputed 29th October elections and the waves of unrest that followed, is Tanzania economy, and more pressing, its flagship infrastructure project, at risk? From a project management perspective, we will walk through what happened, what's actually at stake for major projects like the standard gauge railway, the planned LNG export project, and the East African crude oil pipeline, and other projects, and we'll take a realistic scenario for delivery. We'll be blunt: projects do not die from projects alone. They fail from collapsing risk allocation, frozen financing, supply chain breakdowns, as well as governance that won't hold under stress. Let's start by the facts on the ground, what happened and how serious it is. After Tanzania's October 29th election this year, 2025, opposition parties described the vote as neither free nor fair. Widespread protest, heavy security responses, and large-scale arrest followed. Right groups and some international bodies have reported hundreds of fatalities and thousands of people detained. The government has declared many demonstrations unlawful and deployed security measures across major cities. The situation has already prompted diplomatic concern and limited reassessment by external partners. These disturbances and the government's response, where there are internet slowdowns, heightened checkpoints, and limits on movement, they generate immediate, measurable economic effects. Consumer confidence falls, short-term trade and transport slow, tourism and hospitality revenues collapse, and local suppliers to projects face operational delays. The empirical record shows that elections-related violence can shave points of GDP growth, depress tourism, as well as disrupt exports for months to years if not contained and addressed. Let's have a snapshot where the major projects stand right now. We start with the East African crude oil pipeline, ECOP, which is a pipeline connecting Uganda fields to Tanzania Tanga port. It has reached a substantial physical progress. Owners and the government report roughly 3/4 completion of the pipeline infrastructure. Construction is capital and coordination intensive and depends on continued security of corridor, cross-border cooperation, and stable operations. Let's look at Tanzania LNG. Negotiations and project structuring have been slow and political for years. Major developers such as Equinor, Shell, ExxonMobil, and other partners have publicly stated commitment, but commercial terms and physical stability and guarantees remained to be finalized into 2025. This project is extremely sensitive to investor sentiment and host government stability because its financial models require multi-decade contracts and predictable rule making. Then there is Tanzania SGR, standard gauge railway, which has seen substantive or significant progress, and Tanzania has been actively expanding SGR lines. Recently launched new sections. Parts are under construction or at different completion stages. Rail projects are technically resilient to short shocks but vulnerable to workforce disruption. Supply chain slowdown, rail steel, sleepers, signaling, and refinancing or financing scheduling. So how political violence translates into project risk? Let's look at the mechanics. From a project management perspective, think in 5 channels. One is security and physical risk. Protests and crackdowns can halt construction sites, cause damage to equipment, and make travel for staff and specialists unsafe. That triggers immediate work stoppage and insurance claims. Projects often include clause sets, force majeure, security clauses, among others, but invoking them slows progress and opens the door to costly negotiations. The next channel is financing and counterparty risk. Large projects are financed by syndicated loans, export credit agencies, development banks, and private investors. Political instability raises sovereign risk premiums. They can trigger lender review or suspension and complicate hedging. Even if lenders do not just pull out, they will demand tighter covenants and higher returns. That raises project costs and can kill marginally viable investment. The East African crude oil pipeline near-term cash flows rely on timely completion and export throughput. Any delay increases sunk cost and revenue shortfall. The third channel that you need to think about is supply chain and logistics disruption. Ports, roads, rails must operate to move pipes, turbines, LNG plant modules, rails, and ballast. Checkpoints, curfews, and restricted movement create inventory pileups. Demobilization cost, demoralized crews. For LNG, which requires large specialized shipment and tight sequencing, delays quickly compound into contract penalties. Although it has not yet been contracts has not as or construction has not started, there's a possibility. The fourth channel is on regulatory and contractual uncertainty. When government face political crises, policy changes such as taxation, local content rules, renegotiations of physical deals are common. Investors price this risk heavily. For Tanzania LNG, protracted negotiations of physical terms have already delayed the project. Fresh political volatility may trigger further demands or unilateral changes which investors may resist. Then we have the fifth channel, which is reputation and market risk. Companies and banks that continue investing amidst human rights concerns may face reputation backlashes, protests in home markets, or sanctions or reviews by bilateral partners. International scrutiny and statements by partners reviewing ties can translate into delayed approvals or withdrawn guarantees. Let's look now at project by project risk assessment, where we start with ECOP, which is a high operational exposure, moderate to high financial sensitivity. Why? ECOP is already clinically advanced in construction but requires smooth cross-border logistics, port operations in Tanga when complete, and peaceful access through communities. A sustained security problem will slow final tie-ins and commissioning, and as well as escalate cost. Lenders are sensitive, but completion momentum reduces some investors' exit risk, yet not the risk of schedule slippage and cost overruns. Second is Tanzania LNG, which is high strategic vulnerability. We ask ourselves why. This is a complex, capital-heavy industrial project that depends on long-term stability and final investment decisions. The project has already experienced negotiation delays. Renewed political instability makes the investors' calculus harder. Expect tougher construction negotiations, delayed FID, and potentially deferred development timelines. The third is SGR, which is a medium-term technical risk, low to medium political risk if localized. Why? Real segments under construction can continue if security is managed locally. However, labor disruptions, supply chains, and financing rescooping can slow down new phases. Rail is less politically explosive than oil and gas in many settings, but sustained national instability still raises cost and delivery times. What are the likely short-term economic impacts for Tanzania? There might be a GDP growth drag, where short-term contractions in consumption, tourism, and trade. World Bank and IMF literature shows political instability depresses growth and investment. Expect a measurable growth slowdown if unrest continues or intensifies. There's also investor caution, where portfolio inflows, project bonds, and equity will face higher yields and more conditionality. Planned final investment decisions may be pushed out, increasing project execution risk. Then there is physical strain, where repairing unrest damage and insecurity or increasing security spending can crowd out public contribution to project financing, further pressuring PPP structures and sovereign guarantees. What would make this project resilient? If Tanzania wants to preserve progress and protect investor confidence, the pragmatic steps are clear and very urgent. There should be rapid, transparent political de-escalation, credible independent investigation, and visible steps to restore civic space, reduce sovereign risk fast. External validation such as AU, UN, SADC involvement, this can help. Protect critical supply corridors. Ensure ports such as Tanga, Dar es Salaam, and others, as well as key road links that have secure, neutral access for projects logistics. Reaffirm physical and contractual commitment publicly, where explicit guarantees to lenders and developers, possibly mediated by neutral third parties or multilateral institutions, will calm the market. Independent oversight and stakeholder engagement is another thing that can make the project resilient, especially for ECOP and LNG. Strengthen community engagement, transparent grievance mechanism to limit local escalation. Total Energy and partners public disclosure on progress as a step. More independent oversight will strengthen the trust. Then there should be adaptive project sequencing, where practical accelerate parts of the project less exposed to political risk and defer highly exposed activities until full stability returns. What is the bottom line or the verdict from a project management point of view? Tanzania mega projects are neither automatically doomed nor immune. The East African crude oil pipeline is at delicate but advanced construction stage, makes it more vulnerable to operational interruption than outright cancellation. The LNG project is the most fragile. It requires stable, predictable governance and credible long-term contracts, both of which are immediately threatened by political turmoil. The SGR and other transport works are moderately exposed. They can continue under strong site-level security, supply chain safeguards, but will slow if financing costs rise or if contractors demobilize. Crucially, projects failed not only because of unrest, but because the unrest changes the incentive structure for all parties: lenders, insurers, contractors, and host governments. If instability leads to renegotiation pressure, withdrawal guarantees or reputational sanctions, project risk, stalled constructions, spiraling costs, or costly workarounds. The empirical literature and past African election crises show that even relatively short conflicts can lead to prolonged economic drag and delayed infrastructure delivery. And conclusion that we make, which is realistic and not alarmist: Tanzania has choices. If political leaders act swiftly to de-escalate, engage independent observers, and publicly affirm contractual and physical commitments, ideally with multilateral reassurance, many of the project risks can be contained and timelines largely preserved. If the unrest becomes protracted, expect financing to reprice, developers to delay final investment decisions, particularly for LNG, and construction schedules to slip, with the economic fallout felt across growth, jobs, and future revenue streams. From a project management standpoint, the message is clear. Stability is the single most important de-risking instrument. Money and engineering know-how exist for these projects, but they cannot substitute for predictable politics, enforceable contract, and accountable governance. Without those, even the best designed mega projects becomes expensive, unfinished momentums to miscalculated risk. So thank you for reaching this far. If this is your first time here, please consider subscribing to this channel. Also hit the notification bell so that whenever you upload a new video, you're notified. You can also give your thoughts about this topic. Thank you.